Welcome back. So, if you've been watching the markets lately, you already know it's an absolute roller coaster out there. We're setting the stage today for a wild ride through the unforgiving psychology of recent fintech earnings. Beating estimates, losing the crowd anyway? Yeah, that's just the current reality of financial technology stocks. Let's get right into this explainer.
Right off the bat, look at this sheer absurdity playing out in the news on the exact same day. Over here, we've got Revolut CEO getting sued over a $20 million broker fee he allegedly dodged on a $400 million super yacht. I mean, truly a must-be-nice kind of problem to have, right? Meanwhile, Chime stock is just absolutely ripping, surging 28.5% on a surprise profit beat. It's the kind of massive, trader-shocking move that literally makes you spill your morning coffee. But as we're about to see, not everyone is getting that kind of standing ovation right now. In this earnings season, even a flawless quarter doesn't guarantee a win.
Case study number 1. Fiserv, the legacy giant in the neobank squeeze.
You know Fiserv. They're the Milwaukee-based powerhouse running core banking infra for thousands of banks and credit unions. You probably see their Clover point-of-sale systems at coffee shops everywhere. They are the ultimate old-school incumbent. But, man, look at the harsh reality we're seeing here. They reported an adjusted EPS of $1.84. That is down 26% year over year, completely missing Wall Street's expectation of $1.89. And honestly, the top line wasn't much better. Adjusted revenue dropped 4% to just under $5 billion, $4.96 billion to be exact, missing those expectations across the board.
Now, naturally, when a giant like that stumbles, management has some explaining to do. On the earnings call, they actually went ahead and trimmed their full-year outlook. They heavily flagged the devaluation of the Argentine peso as a major drag on their numbers. So how do you soften a blow like that? Well, they're leaning incredibly hard into a new AI-driven cost-cutting program they've dubbed One Fiserv.
Honestly, it's the corporate equivalent of a veteran pitcher desperately reaching for the changeup because, well, the fastball just isn't fooling anyone anymore. When your main growth engine starts stalling out, you have to go on the defensive. And for Fiserv, that defensive play right now is absolutely slashing costs with AI. And, the timing of this just really stings. Remember what we looked at earlier? On the exact same trading day that Pfizer stumbled, Chime dropped that monster 28.5% profit beat. The legacy incumbent versus the modern upstart. It really feels like a clear changing of the guard, doesn't it? The big takeaway for us here is that legacy payment rails, they aren't immune to the neobank squeeze. They're just a lot slower to show the cracks.
All right, case study number 2, Shift4, the macro victim of global geopolitics. Shift4 processes payments for hotels, restaurants, huge stadiums. Their entire business model basically lives and dies by global travel. So when the world stops moving predictably, you end up with a number like this. Shares plummeted nearly 18% in early trading right after their earnings print. It's a massive, frankly brutal drop that immediately demands some answers. To figure out why, we have to look at the literal anchors dragging down their outlook. CEO Taylor Lauber had to step up and slash their full-year 2026 gross revenue down to roughly $2.5 billion. They also trimmed adjusted EPS guidance to a range between $5.15 and $5.35. And the culprit? He pointed directly to about $25 million in lost business stemming from Middle East travel disruptions, on top of another $20 million hit just from foreign exchange headwinds.
But here's the thing that really puts this into perspective. That 18% drop? It wasn't exactly a sudden plot twist out of nowhere. Shift4's stock was already down over 40% year-to-date even before this print. So this is less like a sudden collapse and more like a sports team blowing a lead they never really had to begin with. The crowd, the investors, they stopped believing weeks ago. What we really need to take away from this is just how deeply interconnected macroeconomics and individual business performance actually are. When your revenue depends strictly on global travel, geopolitics isn't just news you read on your phone, it's literally a line item on your balance sheet. Global events can and absolutely will flatten an otherwise strong payments franchise. Which brings us to case study number 3, Sezzle. Perfection is punished. Now let's look at Sezzle, a buy now, pay later player out of Minneapolis that's been hailed as one of the absolute hottest fintech names right now. And guys, this perfectly illustrates a flawless quarter. Look at it. It's just a sea of green. Revenue hit $149.7 million. That's up nearly 52% year over year, beating estimates by almost 10%. Adjusted EPS came in at $1.13, topping consensus by over 11%. And the cherry on top, management actually raised their full-year guidance to a $5.25 midpoint. I mean, they did everything right. In the old days, beating and raising was all you needed.
And yet, despite crushing every single estimate and confidently raising their guidance, Sezzle's stock still plummeted 22.1%. I mean, wow. It is an absolute shock to the system if you're out here thinking the market purely rewards good numbers.
So what is actually happening here? Well, it boils down to some pretty brutal market psychology. When a stock is priced as one of the absolute hottest names in the sector, its valuation is already baking in total absolute perfection. Think of it like an Olympic gymnast. If the routine is expected to be flawless from the get-go, they get docked points the absolute second the landing isn't a perfect 10. In this current environment, being just great quietly becomes, well, not great enough.
Let's pull this all together. Section 4, the big fintech takeaway.
So let's build a complete picture of the current market out of these three stories, wrapping it all up. First, Fiserv proved beyond a doubt that legacy infrastructure is just not safe from the neobank tide. The pressure is very, very real. Second, Shift4 showed us that geopolitical and travel headwinds can flatten even the most robust payments franchise. And third, Sezzle taught us probably the harshest lesson of all today. Beating estimates means absolutely nothing to investors if the market has already priced you for the moon.
Now, if you enjoyed this explainer and want to dive deeper into the source material, definitely go subscribe to Fintech Stacks for daily fintech signals, and you can actually follow their trades over on Robinhood Social. And as a quick reminder, this explainer is purely for information and entertainment. Absolutely not investment advice. Just assume I'm sitting here in a cozy fintech hoodie carrying way too many debit cards. I want to leave you with this one thought to ponder today. In a market this incredibly unforgiving, how can any hypergrowth company actually win when they're already priced for absolute perfection? Something to chew on. And hey, while you're at it, send this explainer over to that one coworker who still thinks buy now, pay later is just a passing fad. Thanks for hanging out and learning with me today, and I'll see you in the next one.